Today we have a good subject related to the valuation method of the startups, the 9 methods. So before we start the official meeting, I would like to invite our chairman, CA Jose KV, to give a opening session to our meeting.
Hello, good afternoon, everybody. Most respected CA Tarun Jagdish, today's speaker on this CP virtual meeting, and MC members, Salim Secretary, Tony, MC member, and other committee members, and senior members and friends in profession. So it is a great pleasure. Today we are having another CP program on virtual platform. As we know, we already started many programs on the physical mode, but there are many requests for online seminars also for CP programs. But there are some restriction now on the online CP program. The maximum CP hours will be restricted to 8 hours per annum. So we have to go. We have to have more physical meeting, but definitely we will have more meeting on physical as well as online, because there are advantages of online meeting by the way that today Mr. C.A. Tarun Jagdish is joining us from, not from Cochin, from Calicut. Now he is in Calicut and he is from Trivandrum, but he is joining from Calicut. In that way we can have many, very eminent speakers on our programs. So there is an advantage, and also there is an advantage like many members can join, even though they are on the assignments in a different place, not in town, or they could not come physically to the institute. They can join and have more learning on these special sessions. And today we have a business valuation for startups, and Tarun is going to give a deliberation on 9 methods how to value a business, especially for the startups. We know there are many startups are coming up, on the incorporation stage. We also involved in many startups, and we also would like to know how we can value our clients, or how it will be, what are the different methods to value and see the growth of our the startups. And as we know, there are many IPOs are coming up even for startups, or we can see many IPO like LIC is over. So the valuation, business valuation, is one of the very important area where our members should be very familiar, or as well as the expertise on the methods of the different methods for the business valuation. So today we will hear CA Tarun. I am sure this will be a great learning session for all of us here. On behalf of Ernakulam branch and all the participants here, I cordially welcome our CA Tarun Jagdish to this CPA seminar. And I also welcome all the managing committee members and all senior members and friends who have joined from different places. And we have many members outside our branch also joined on this virtual seminar. So once again, I welcome all of you, each one of you, to this CP seminar. Thank you. And over to Salim.
Thank you, Chairman, for the wonderful sessions. And today's speaker, I would like to introduce today's speaker. Our today's speaker is Tarun Jagdish from Thiruvananthapuram. He is a practicing chartered accountant, and he started his practice from 2020 onwards, and he is very familiar with the students community also. Without much time, I am handing over the mic to the Tarun Jagdish. Over to you.
Good evening, everyone. Thank you so much, sir, for the wonderful introduction, and thank you, Joe, sir. Good evening, everyone. My name is Tarun Jagdish. As Salim sir has rightly said, I am a practicing chartered accountant, but I am a trainer by passion. I'm also a CA final faculty. I take handle classes for SFM normally. So Tony is someone whom I know through them. Thank you, Tony, for introducing me here. All right. So after being a finance faculty, I was very much passionate about valuations because it comes in the final level topic called as mergers and acquisitions. So like that, I started doing more and more and more research, started reading more news on money control and different platforms. That's how I decided that I will go for a registered valuers course, and I finally enrolled for it. Learned many more in-depth ideas about valuation, and today I'm very happy to practice in that area because that's something what I enjoy, and I believe all of you will also enjoy doing this because valuation is a very dynamic field. It's an upcoming area, especially in a place like Kerala. There are a lot of opportunities coming up on valuation these days. So today's seminar is on 9 methods of business valuation, which can give you a fair idea about many of your clients as to how their company is getting valued. I would like to share my screen first. And one more request, I would like to have some interaction if that's possible. Everybody is having a chat option, right? Or is it only a one-way communication? I believe we can chat, right?
Yes.
Just a request, I'll ask you a few simple questions. Just give an answer so that we can have an interaction going on. Otherwise, me speaking for a very long time, listening will be restricted to maybe 10 minutes or 15 minutes. I don't want that. So just request you to keep responding. Okay. So I'll just share my screen now and I'll ask you a few questions. All right. I'll just share my screen. Okay. So this is the topic for today. 9 methods of business valuation. All right, my first question to you, you must have heard of this brand, Byju's app. Any idea what's the valuation of Byju's app today? I don't need an accurate answer, just a guess can also be fine. Just approximately how much do you feel is the valuation for Byju's app? Anyone? All right, I'll give the answer. Okay, it's turning out to be $10.5 billion. Huge. Now, this is a company which started from Kannur. Zomato, any idea what's the valuation for Zomato? $8.5 billion. Again, you know, these zeros also how much to put, we will be confused despite being chartered accountants. Swiggy, $9 billion. Now, friends, when you look at these valuations, everybody will be surprised. Oh God, what is this kind of valuation? $9 billion. Zomato is around $8.5 billion. So I did some research on Zomato versus Swiggy to find out how are they getting this kind of huge valuation. And friends, when I did that research, I realized that Zomato and Swiggy both are running at losses, not normal losses, huge losses. Zomato's financial performance of I think 1920 is showing a loss of 1000 crore rupees. Friends, now that's not a small amount, it's a huge loss. But still, when you look at the valuation is turning out to be $8.5 billion. So I would like to start my session with a comparison. Which is better? Swiggy is better or Zomato is better? Let's check these two, analyze these two, and then I will tell you how these valuations are coming. And in order to value Swiggy, Zomato, Byju's app, any other IPO that is coming up, one of the basic rules are the 9 methods that I will be sharing with you today. So after that, we can have an interactive session also where you can ask me all your doubts on valuation. Now let's compare Swiggy and Zomato. Which one is better? Zomato is having a valuation of $8.5 billion. Swiggy, I'm sorry, I think it's got interchanged. If I'm not wrong, Swiggy is 9 billion and Zomato is 8.5. Yeah, I've shown it correctly over here. Yes, 8.5 for Zomato, $9 billion for Swiggy. But friends, Swiggy is right now the highest food tech right now in India. All right. But these two companies are running at huge losses. I have just given some comparative numbers of Swiggy and Zomato over here. If you look at the revenue for Swiggy, it is around 2,956 crore. You have an expense of 6,864 crore. This is the recent ones. 3,900 crore is the loss for Swiggy. 2,451 crore is the loss for Zomato. Friends, 1,000 crore was for a year before this. Huge losses. Despite this, valuation is $8.5 billion, $9 billion. How is this valuation coming in? Now, when I go to the next one, they have a couple of investor groups aggressively supporting them. For example, when you talk about Zomato, they have companies like Glade Group Capital, CDH Investments, and Financials, InfoEdge. They are regularly funding Zomato. And same way, Swiggy also has got their own investor pitch team, Innovent Capital, Korea Investment Partners, Mirai Assets, etc. So these people keep pumping money with the hope that tomorrow they will be able to generate more money and more results out of this. We went in depth to analyze the performance of these two companies. And one thing what we came to know was per day, if you look at the deliveries, Zomato is delivering almost 12.5 lakh orders per day, whereas Swiggy is delivering 14 lakh orders per day. So the order capacity is huge. And that is one reason why they are getting this kind of huge valuation. And when you look at the percentage of smartphones, Zomato, it is 12% and Swiggy is 10%, which means if 100 people are using, this Android or Apple driven phones, Zomato has captured 12 out of the 100, whereas Swiggy has captured only 10 out of the 100. Now, despite they have captured a very low market, they are able to generate a very, very huge revenue of 2,956 crore and 2,486 crore. So, what they are trying to tell here, or the argument based on which the valuation has come, is that Zomato right now has 12% market share. If this 12% becomes 20%, all right, if this 12% becomes 20%, the cost will remain the same, because majority of the cost incurred by Zomato is fixed cost. Fixed marketing cost is there. Earlier it was variable, now it is fixed. Fixed marketing cost is there. Fixed salary cost is there. Fixed programming cost is there. But revenue will go up from 12% to 20%. There will be a huge jump in the revenue. It will go up to maybe 6,000 crore or 7,000 crore. That point, the company is going to make huge profits. Yearly profit will be easily 2,000 to 2,500 crore. So if you start calculating the valuation based on this profit of 2,000 to 2,500 crore, obviously future there is a huge capacity, and that is the reason why Zomato and Swiggy are valued so high. So friends, one of the very, very important lesson that we have to learn is, unlike all the traditional businesses that we were talking about, today, if you are talking about a startup, especially in the IT business, that company might be at a loss. But even though it is at a loss, does not mean that the value will be negative. Lot of IT companies are there. Negative means huge negative losses, huge, the financials are not pretty good. But when you look at the valuation, they will be very, very high. That's only because of one thing. None of the investors are worried about today's cash flow. Every investor is bothered only about one thing: tomorrow, how much money will I make? Tomorrow, how much revenue will I make? Tomorrow, what will be the profit? So value of any business, value of any startup, value of any company is not dependent on today's cash flow. It is dependent only on the future cash flows, the cash flows which happen after 1 year, 2 year, 3 year, 4 year, towards perpetuity. That is the reason Zomato is having high valuation, Swiggy is also having high valuation. So one rule I believe everybody is clear with: even though your business is at a loss, that does not mean your value is negative, and your value depends on future cash flows. If you're clear with this, I will proceed to the next step, where I will be sharing with you the different methodologies of valuation, the 9 methods of business valuation. All right. So let's go to the 9 methods. This was just an introduction. All right. I'll go further and I'll share with you some problems. Startups, even you must be auditing many startup companies. The main issue that most of you would be facing with startups will be: point number 1, they will not have any records. Accounting records will be a disaster. Many cases, we ourselves prepare some accounts for them so that they can, present something in front of the authorities. No revenues, very limited revenues, huge losses. They don't have, they're depending completely on non-public equity. Many of them will have their relatives investing money into them, or it will be a group of 4-5 people together coming and, depending on the investment that they get from the nearby people. Many companies do not live on. There are so many companies who start and then they ultimately fail. In fact, there is a research which has been done which says that if there are 100 startups today, 90 startups will absolutely fail. Only 10 will survive. But these 10 will go to a very different height altogether. And that is where they get this huge level of valuation. They have various different claims on value. That's why we are talking about 9 methods of valuation, because value is not something which can be precise. It is an approximate understanding, and that is what we are going to discuss here. Last one, investments are illiquid. Unlike all the traditional companies, if you talk about a tile business, they have tiles with them. If you talk about hypermarkets, they have some stock. If you talk about textile, they have some stock with them. IT, nothing is there. All the money is going in salaries. So you only have an intangible asset that is coming out or that is popping out, which is the reason why many people are afraid to put money into the startups. And there are another class of people who are very much excited with the fact of investing monies into the startups. All right, so these are the major issues what the startups are actually facing. Okay, as I mentioned earlier, friends, 90% of the startups actually fail. Only 10% of them succeed. With this, I will go for the 9 methods, which are a very important methods, friends. I'll go a little slow here. Okay, after every method, I'll give you a 5-minute slot. If you have any doubts on those methods, you can ask me, because in the end, if I ask you doubts, if you ask me doubts, you might forget what's happening at the beginning. All right, so I'm going to start with the 9 methods. Even before I proceed, if you have any questions to be asked until what I have taken now, please feel free to ask. Then I will start with the 9 methods of valuation. Yes, I believe everybody is clear so far. Okay, so shall I proceed to the next slide? All right, friends, these are the 9 methods of valuation. Right? The Burkas method, you have the risk factor summation method, scorecard method, comparable transactions method, book value method, liquidation value method. Then you have discounted cash flow method. This is a very long method, friends. I will elaborate discounted cash flow in a much higher depth later. First, I'll cover the 9 methods, and then I'll write and show you the discounted cash flow method, because that's what is the best method. And as a registered valuer, this is the method that is allowed to be used along with net assets method. All right. Then you have a method called as first Chicago method. And finally, we have a method called as a venture capital method, right? So let's start with the first methodology over here, which is called as the Burkas method. Burkas method is a very, very simple method. No complications involved, no mathematics involved. This was created by a person called as Burkas. He said that we will keep 5 criteria for your business. Each criteria will be equivalent to $400,000. Friends, majority of the valuation is happening in dollars. I'll just write down over here and explain. Okay, they say you will have $400,000 into 5 criteria. That will give you an overall $20 lakh, or they say that the basic valuation has to be around $2 million. This method does not do any basic calculation. It says that if you comply with all the 5 criteria, if you are good at all these 5 criteria, you should ideally be getting a valuation of $2 million. That is what this method is emphasizing on. So let us go and check what are these 5 criteria that we are talking about. The 5 criteria are: first one, sound idea. You should have a very good base idea. Prototype, you should have the best technology. Quality management team, you should have the best team. Strategic relationships, how much connections they have in the outside market, how many investors are there who are willing to pump money into the company. And product rollout or sales, how fast can they roll out the product. Now let's compare this with, taking a basic example of, let's say, Zomato or Swiggy. If you talk about Zomato, they had a simple idea. The idea was very simple: delivering food. I should deliver good food. If I'm able to deliver food hot and with good service, people will like this. And this idea was good. So according to Burkas method, if this idea is good, they should be given a valuation of $400,000 flat. In fact, friends, I can say that every business starts with a unique idea. And every successful company has come up with some unique idea. Baiju's app, if you talk about, it was launched at a time when nobody even thought about online training. At that time, Baiju's app was already there in the market. If you talk about Ola, Uber, they came into the market with an idea that they will be providing taxi service at a much cheaper price than whatever is being provided by all the other local people over there. If you talk about Make My Trip, they had a very simple idea that people can fly at a very cheap price without any commission. Policybazaar.com. All these products have come with a unique idea. Every time you have a new idea, that idea gets converted into a particular product, and that product starts generating revenue for the company. So as per Burkas method, if you have a sound idea, your company valuation can range from $300,000 to $400,000. I believe everybody is clear with this. Second point is about technology, prototype or technology. Now, if you talk about Swiggy, Zomato, they are using the app-driven technology where people will install the app and they will be doing the particular service. There are many automatic washing machines or robotic cleaners around the house. That is another base of technology. Any new unique technology which has got a high scope in the future, if you have that kind of technology, you will be added another $400,000. So friends, we spoke about a sound business idea. We spoke about technology. After this, we will talk about the next one, quality management team. Now, management team makes a big difference. That is the reason Elon Musk, the moment he joins a particular team, the valuation will start going up. It all depends on the personalities also. You have a good team, people whom you can trust, that should be equivalent to another $400,000. All right. Fourth one, strategic relationship or go to the market. Now, as I showed you earlier, Swiggy, Zomato, they have a group of investors willing to invest money into the company. It can be any form of strategic relationship. You have political support, that is good. You have investor support, that is good. You have supplier support, society support, any kind of political or any form of support that you have, that will also end up giving you a 400,000 valuation. In fact, recently, I just went across an app which is, I think, launched in Kochi with the name of Rezoi. I'm not sure if you have gone through this app. Okay. This app, when I went through it, they are always giving KWRA on top of that. This, I'm not sure about the full form, but what I understand is that this is basically Kerala Restaurant Association. So the KWRA, which is a restaurant association, is supporting this app. And this app is something similar to Swiggy or Zomato. So this is a strategic support which they are receiving. And due to this support, they will be given an additional $400,000. So if you don't have that, it will become 0 or 100,000 or 200,000, depending upon the intensity of the strategic relationship which you have. Next one is product rollout or sales. In case of Swiggy and Zomato, they have a delivery team absolutely subcontracted, working efficiently. That becomes the product rollout or sales. For other things, it depends upon what kind of products you are rolling out. If you have a good product rollout, again 400,000. So friends, if you add up all these 400,000 into 5, you will get a valuation of $22 million. But in this example, they have shown basic idea is not that very good, so 300,000. Technology is not very good, 100,000. Quality management team, 300,000. Strategic relationship, 200,000. Product rollout, 100,000. So basically, instead of having a $2 million valuation, this box is having a valuation of 1 million. Box is basically a small terminology I use for companies, right? This method is what we call it as the Burkas method. I believe you're clear with this, friends. I'll give you a 1 minute time. If you have any doubts, please ask me. Else, I will go to the next method. Okay, sir, I have a message. 1 minute. I'm not able to view the message. Just a moment. I'll just, yes, it's here. Yeah. Sri Kumar, sir, good evening, sir. Your doubt is what is the basis for each criteria. Now the basis for each criteria, are you trying to say that how that 400,000 has arrived or how this 300,000 has arrived, sir? Basis of valuation.
Yes.
Okay. Sir, basically, Burkas was a person who said that generally every startups which are good should have a basic valuation of $2 million. Now that 2 million is something what he found out from the experience that he had with the companies that were operating around Burkas. Okay, but that is not a very good method. This is only one of the methods. We are having total 9 methods. In fact, this method, the drawback is that it's a flat method. 400,000 into 5, 2 million maximum. You cannot go beyond 2 million. I think that is one of the doubts that somebody has raised, Mr. Deepak Jose. Yes, sir. The maximum valuation under this method will be $2 million. You cannot go beyond that. But this is only one of the methods. And the drawback is it's very subjective. And how much ever you do, it will never go beyond 2 million because Burkas says that maximum value that you can provide to a startup should not be exceeding $2 million. It's a theory created by Burkas, but which is used, globally. Yes, friends. Any other doubts? Sri Kumar sir, I believe your doubt is clarified. Thank you, sir. If you have any other doubts, please let me know. Otherwise, I'll go to the next slide. Sorry. All right, friends. So I believe we are done with the Burkas method valuation. Now the second method of valuation is called as risk factor summation method. Burkas method was $400,000 into 5 criteria. So we were getting the answer as $2 million, right? Under risk factor summation, we will find out the base value for the company. And after taking the base value, we will identify different forms of risk. For example, I can have some political risk. Okay? People who were in India, when demonetization came, that was a risk for the people in India alone. It was having no risk at all for the people outside India. So if there is a risk involved, our valuation will fall down. COVID was a non-diversifiable, universal risk. So I'm not considering that fact. You can have some technology risk. You might have a risk that the person who is handling your IT, he might leave you, okay, or you're not very strong in the technology part. You can have different types of risk. So what this method says is that if you have high risk, I should reduce my value. If you have low risk, you should increase my value. So I'll just go and show you with the slide. All right. In this, what they will do is that we will first find out an initial value for the box. And after taking the initial value, what we will do is we will add or reduce depending upon various factors. All right. This is a very simple example of risk factor summation method. Now, suppose what I will do is I have a company, which is my client. It is, compared to that, similar businesses are listed in the stock market. Now, for example, if you talk about Swiggy, Swiggy is not listed, Zomato is listed. Zomato will go and check the value. Assume the value for Zomato turns out to be $15 million. Assume. Just highlight this. Right? And I'm talking about Swiggy. So what Swiggy will do is Swiggy will start its valuation with $15 lakh or $1.5 million. It will check in management risk. Management risk is very low. Risk is low. So what I'll do, I will add another 500,000. All right. Next one. Stage of the business is very much normal. No problem at all. No addition. Political risk, normal. No addition. Normal, no addition. Competition risk very high. There is high competition. What they will do, they will reduce $500,000. Technology risk is very low. Add $250,000. Litigation risk very low. Add another $500,000. Reputation risk very low. Add another $500,000. So from here, I will adjust all these factors, and after adjusting, I will derive a closing valuation of $2.75 million. So basically, I start with a comparative company, whatever is their value, and then I will adjust my company for the plus or minus happening for different types of risk which affects my business. I will again give you a minute's time, friends. Please go through it. If you have any doubts, please let me know. I hope the network connection is comfortable and the audio and video is clear.
Yes,
Okay.
perfect then.
Okay. Prabhu sir, your message is that how is the initial value arrived? That's what I told you, sir. We are comparing it with a similar company. Now, suppose I'm talking about Swiggy. Swiggy is not listed, but Zomato is listed. So what will Zomato do? Zomato has got a net valuation you can arrive from the stock market. For example, normally I use this money control platform to derive these values. So I find that very comfortable. So I believe I'll take money control. I come over here and I just search for Zomato. Yes. Here they are showing that the price is 56.85 rupees per share and they'll be having the total value. Market capitalization is around 44,000 crore. All right. Or the per share price is turning out to be 56 rupees. So this 44,000 crore can be the base value for Swiggy. If Swiggy is trying to find out its value without being listed, then what Swiggy will do, it will compare its risk. So compared to Zomato, my management risk is very low. So I will add 500,000. Compared to Zomato, my stage of business is almost the same. So normal, no change. Like that, you compare and then you arrive at a different valuation. It can be a plus 500,000, minus 500,000, plus 250,000 or minus 250,000. Sir, I believe you are clear with that. Yes, Sri Kumar sir, you have again asked a message. I suppose the estimated value is again subjective. Sri Kumar sir, entire value is subjective. Entire. You know, there is a wonderful saying. It is better to be partially correct than be accurately wrong. That's all about valuation. You are not 100% right in valuation ever. No valuer can always certify and tell this is the exact value. It's impossible. But we will be partially correct. That's absolutely better than being absolutely wrong. All these values are subjective. That's why what I normally do for my clients is that I'll provide them all the 9 methods. I'll give a table, method 1, 2, 3, 4. So if there is a huge deviation among the methods, we can always go and cross check that where are we going wrong, if there's something wrong with the calculation that we have done. Krishnan sir, yes. Maximum is plus or minus 500,000, not 550, $500,000 as per risk factor summation method. The benchmark is plus or minus 500,000. You cannot do plus 600,000. All right, I believe everybody is clear with this. Can I go to the next methodology now? All right, okay. So we are done with risk factor summation method. The next methodology that we have over here is called as the scorecard valuation method. Now friends, the scorecard valuation method, you start in the same way as you do for RFS method. So it is similar to risk factor summation method. Okay, you have a base valuation for your box, okay, or for the company. And then what you do is, instead of taking the plus or minus, we take the weights. And based on the weights, we derive at a closing valuation. Maybe it's better that I will show you this. Okay. Now here, if you see, they have taken the base valuation as 1.5 million. Team capacity, they are allotting a weight of 40%. Market size, a weight of 20%. Competition is having a weight of 10% and technology is having a weight of 30%. Compared to an average product, my team capacity is 125%. Compared to an average product where, you know, I have 100% at par with the average. Here I'm 15% with the average and the last one I'm 75% with the average. Once I get this, I will take the weighted average. So what I'll do is I'll do 40 into 125%. Plus I will do 30 into 100%, plus I will do, let us say 20 into 15%, and the last one would be 10 into 75%. If you add up all these things, friends, you will get this number, 117.5. Okay, and then what you will do, my base value was $15 lakh. I multiply with 117.5%, I will get the closing valuation as $17,60,250. I'll give you 2 minutes time. Please go through this. And if you have any doubts, you can ask me. I think there were a couple of messages I missed out earlier. Alan, sir, you have a doubt. What is the criteria for giving a monetary value for each risk factor that is to be added or deducted? All right. Alan, sir, in the previous case, now we're talking about this case. For example, if you feel that the risk is, there are 4 criteria coming over here. You have low, or we'll call it as very low. You have low, you are having high, you are having very high, and then you are having normal. If it is very low, according, that's a judgmental area again. But sir, if you feel it's very low, you can go for, a plus 500,000. And if it's a very high, you can go for a minus 500,000. If it is only high, according to you, according to your judgment, it can go to plus 200, minus 250,000. And if it is low, you can go for plus 250,000. That is the way how we do it. So there are 4 categories over here. Okay. One is high, very high, low, very low. Now, what is high, what is low? It is a valuer's judgment, right? You are asking why we had chosen 500,000. Now, that methodology is created like that. The methodology says that if the risk is very low, maximum plus you're supposed to give is 500,000. You're not supposed to give beyond 500,000. And these are all, they derived at this value by doing some statistical researches and, market study. So according to them, the deviation should not be more than 500,000. Now that's a market understanding. Burkas said it should be 400,000. Risk factor summation, they're saying it is 500,000. All right. Okay, sir. I believe you're clear. Okay. Now this is scorecard valuation method. Please go through this method. And if you have any doubts on this method, please let me know. All right. Can I go to the next part now? Fine. I'll go to the next part now. All right. So this is scorecard valuation. The next method that comes is comparable transaction method. Now, this is a very, very simple method. All right. Alan, sir, yes. I'll share the PPT the moment the session gets over. I will share it and you will be receiving the PPT. Right. Okay. Comparable transaction method is a very simple method. It basically checks. Now, as I showed you earlier, Zomato was having 12% of the users. Swiggy is having 10% of the users. All right. Now, Zomato is already listed. I think when I checked the money control platform, we got to know that the market capitalization is around 44,751 crore, right? So if I use a calculator based on this, I can very easily find out the value for Swiggy. Okay. So with 12% market share, if they are having 44,751 crore, Swiggy's valuation should be around 37,293 crore. How did I get this answer? I use the formula 44,751 divided by 12 into 10. So they check somebody else is having 1 lakh users. They are having 100 million valuation. My box is having only 55,000 users. And that's why my valuation will turn out to be how much? So the formula here would be $100 million divided by 100,000 into 55,000. So if I do this, I'll get the answer as $55 million. A very simple method. Yes. So we have to take many factors, and that's actually taken for many IT companies, okay, especially they take things like what is the monthly recurring revenue, they have HR headcount, number of outlets, weekly active users, WAU is the term that they use. In case of medical, they use the patents which are filed, and you can take, from the P&L sales, EBITDA, gross margin, etc., etc. Anything can be taken and you can do it. This method is also called as top shop approach. Please go through this, friends. If you have any doubts, please ask me. I don't want to just rush. I just want you to all absorb whatever is taken. I believe this method is simple enough and everybody is clear with this method. Perfect. Yes, they have given one more numerical example over here, which can also be used for understanding the comparable transaction. Okay. They will have a revenue multiple, suppose it is 3, or VAU multiple 2.3, etc. So if that similar box is sold for 957, I have a revenue multiple of 3. You should multiply this with 3 to get the corresponding valuation. So like that, you have got everything given and you can finally derive at a comparable value. All right. Next one is book value method. Book value method is a very simple method, friends. You all know the book value method. You all have been doing this. Okay. The book value method is very simple. You will just take the net assets. Friends, one moment. There is a power failure over here. Just a moment. I believe all of you can hear me. I think only my screen has become a little blurred, right?
Yes, we can hear you.
Okay, just a moment. Let me try. All right, I believe you all can see me now. Okay, fine. I'll continue with my session now. So net assets method is a very simple method where what do? We take the capital plus we take the reserves. So basically none of the goodwill or any such factors are considered. All right now, or I can take the assets minus whatever is my outside liabilities. All right. Now, friends, is this method a good method to value the business or a bad method? Can you please chat and let me know? Is this a good method or a bad method? Friends, this is a very, very basic method. If you take Zomato's valuation using this one method, you will get a huge, huge loss. But friends, despite being a bad method, I'm not sure if you're aware of this, ICAI has given proper instructions that every registered valuer, whoever is doing valuation for the company, they should strictly use this method also in the valuation report. That's because the investors or the people who are seeking investments are always looking for a lot of money. So they somehow want the value to be very, very high. I have come across so many people, they will come and they will tell that I give them a valuation report. Suppose I give them a valuation report that look, your valuation is 20 crore or 30 crore. That fellow will come and tell me, no, 30 crore is too less. I need a valuation of 70 crore. I will tell the investor somehow and get the money. You give me a valuation report for 70 crore. That's a very, very dangerous situation. And we have to protect ourselves from the code of ethics also. And we should be very clear on what we are doing. Luckily, ICAI guidance note is very clear that if you are doing a valuation, in your valuation report, you should mention the book value also. So when you start showing the book value and the valuation report, obviously anybody going through it having common sense can compare that as per the cash flow method is having a valuation of 100 crore or 80 crore, and as per the book value method is having only a loss or a very limited value. He will use his common sense before investing the money. In fact, normally we use weights. We give a weightage of around 70% for discounted cash flow method, 30% for book value method. That way, even though the value gets a little inflated, it can slowly be brought down. All right. So book value method is a very simple method. You just have to take the assets minus outside liability. But the risk factor is that it will show a very, very low valuation. Okay. I believe you're all clear with this point. I'll go to the next one now. Yes, in the book value method, you will take all the tangible assets. You will not take the intangible assets, and you will only take the outside liabilities, whatever is there, you will be considering that into the picture. All right. Similar to book value, we have one more methodology called as liquidation value method, friends. Normally, we don't use this for startup valuation unless the startup is about to liquidate. Many startups have started. COVID time, so many startups started liquidating. At that time, many people wanted to exit the company. During that time, we had to use the liquidation value method. Now, you are all familiar with the liquidation value method. As per this method, what we have to do is we will have to show everything at a realizable price. We will have to show everything at a sale value. So whatever is the actual sale, if you are having assets, sell the assets, how much money you receive, liabilities, actually you realize the liabilities, how much money you get, and such value is what we call it as the liquidation value method. I'll give you a minute's time. If you have any doubts on either book value method or liquidation value method, you can ask me. Else we will go to the next methodology. Friends, unfortunately, there's a power failure. Hopefully, it will resume. There's one more query that has come. If sales is yet to start, what can be the valuation that can be given? All right. Manu sir, the answer for that is that many companies are there which are at an absolutely zero stage. At that time, we have two types of valuation. One is called as the pre-money valuation, and the other one is called as the post-money valuation. What we have to do at that fact is we have to take the management estimates for turnover, which should have very deep logical reasoning for the sales. They cannot simply tell that my company will make a 5 crore turnover. No, they have to give absolute justification for how the revenue has been arrived at. With that assumption, we can make a valuation. But tomorrow, if the assumption changes, our valuation will also change. All right? Yes. Any other doubts on this? All right, friends, I'll go to the next part now. Okay, so we are done with 6 methods so far. We are done with the Burkas method. We are done with the risk factor summation method, scorecard valuation method. We are done with the book value method. We are done with the liquidation value method, and we are done with comparable transaction method also. The 7th method is the most elaborate method, friends. I would be taking this in a much more elaborate manner. Okay, I want to spend some time to show you how we calculate beta. I'll be writing and showing you this entire thing because I don't think a PPT can help me in that case. So I'll be writing the entire thing, giving you the examples and showing this entire discounted cash flow methods. For time being, just understand one very important rule, that value of any business is nothing but the present value. Now, this is something what you learn in your financial management classes. It is the present value of the future cash flows that your business can generate. It's always like that. If your business can generate high future cash flows, your value of the business will be very high today. If your business can generate less future cash flows, today the value of the same business will be very, very low. So that methodology where we take the future cash flow and then we discount this using a discounting factor. I will tell you how to derive it, the discounting factor also. It's a little bit technical stuff. So I'll write down everything and show it to you. And that written down fact, I will be PPT, I will be sharing it with you also. So this is the best method, and this is a mandatory method to be used if you are valuing the startups. Discounted cash flow method. To this, you have to give an adjustment for something what we call it as DLO, discount for lack of marketability. I will explain this also in depth because it's a very long method. I want to do it after I complete all the 9 methods. All right. So that is about discounted cash flow method. So I'm keeping it half complete now. Remaining half I will explain to you after I complete the remaining 9 methods. If you have any doubts in whatever I mentioned right now about DCF method, please ask me. Otherwise, I will explain it once again in the end. I think there is a message which I have missed out. James sir, okay, you have a doubt. There is a comparable startup which is not listed. So we may not get all the data. What can be done in that case? Sir, when you have a comparable startup which is not listed, taking those numbers alone will not help. We need some data about some company which is listed. If it is not listed, you go by DCF methodology. DCF method, even though the company is not listed, we can always find out an approximate valuation for that company based on the assumptions that we have. All right. So I believe there is no other doubts in DCF methodology. Can I go to the next one? The next method is an elaboration of DCF cash flow method. When we do DCF, people always have doubts that whether our valuation is justifiable or no. In DCF, if I create 3 values under this, the first value is called as the optimistic value. The second one is called as the most likely value. And the third one is called as the pessimistic value, right? Optimistic value would mean high or low. It would mean very, very high. Most likely value would be the average, and pessimistic value would be the lowest value, right? When you have the highest value, that will be given a particular weightage. Normally, as per the statistical observation, the weights are given in the ratio of 1:4:1. But when you do your valuation, if you feel optimistic is having a much higher weightage, you can always change the weights. But statistically, 1:4:1. 4 for most likely, 1 for high, and 1 for low. That is the normal ratio which is used when you go for a DCF with a venture capital. So this methodology is what they call it as first Chicago method. Now again, here I need to elaborate what is DCF. Only then we'll be able to understand the first Chicago method better. So I'll give you a minute's time, just go through this. If you have any doubts on this method, please ask me, else I will go to the next methodology. I believe there is no other doubts here. So friends, we are done. Okay, I think, okay, there is a wonderful doubt. Did someone from Chicago formulate this? Sir, I need to check who has formulated this method. Why they call it first Chicago is a very, very good question. I will do some research on that, sir, and I'll be in touch with you. All right. For time being, since everybody calls it first Chicago method, even I'm calling it first Chicago method. All right, I'll go to the next one. So we are done with the first Chicago method also. Final, yes, as I told you, worst scenario, best case scenario, normal case scenario. So you can give a different weightage also if required. You can give a probability of 20% for the best or worst, 70% most likely, 10%. Statistically, 1:4:1 is the standard ratio that many companies use. All right. So I believe you are clear with this. Just go through this once. These are all numbers which they multiply to get $81 million. Okay. So I believe you are all clear with this part also. Okay. Last method is called as venture capital method. This method is something what many venture capitalists actually use. Venture capitalists are those people who put money today with only one hope: after 3 years or 5 years, I will sell my share and I will relax. Friends, luckily the power is back. Okay, so I'll just repeat what I said. Just give me one moment, friends. I'll just change my video setup. Yes, I believe you all can see me now. Okay. I'll share my screen. All right. All right. So the venture capitalist people are those people who will say that today I will invest, let's say 10 crore into this company. After 5 years, I want 100 crore. I will sell off my share, then you do whatever you want with the company. Such people are whom we call it as venture capitalists. These people are not at all worried about what is the value today. They work backward. They work from the fifth year. I need a valuation of $100 million or whatever number. Multiplier, they'll get the value of today. This is basically industry terminology what they use, which I'll show you here with this calculation. $100 million is my exit value. So after 5 years when I exit, I should be getting $100 million. They look for 20x. 20x means if I put 100 rupee today, I should get into 20 times after 5 years. That's what they call it as 20x. So it's called a multiplier. So once you derive at the multiplier, $100 million, 20x means today the company's value should be $5 million. This $5 million is called as post-money valuation. I need to first explain to you what is post-money valuation and what is pre-money valuation. There are two types of valuations. One is called a post-money. Oh God. Sorry friends, some technical issue here. I'm losing my electricity. One is post-money valuation and the other one is pre-money valuation. Post-money valuation means value after I invest into the company. Whereas pre-money valuation means value before I invest into the company. There are two terminologies. Pre means right now I'm running my business. I'm not getting any investment. Let me run it like this. How much will be my value is called as my pre-money. But I'm in a bad need of 1 crore rupees. If I get this 1 crore, I put that money into the business, my company valuation will jump up because I can suddenly sell more and make more profit from the market. That valuation is what we call it as post-money valuation. So if you come and look over here, this company after investment, the valuation should be 5 million. That is today's valuation. Okay. Minus today I am investing $1 million into the company. Okay. So if my post money valuation is 5 million and if I'm investing 1 million, my pre-money valuation would be around $4 million today. All right. Now $4 million is normally for the listed companies. Listed companies having good marketability, people are there to buy the share. I am an unlisted company, people don't come to me. So for that, I will do a dilution. Okay, dilution of 70%. This can be 70, this can be 80, it can depend upon whatever you want. So if it's a 70% dilution means I will take 4 million into 70%, I would get the net valuation as $2.8 million. So this is going to be my today's value. This is little tricky. I'll give you a minute. Please go through these numbers. I will repeat the whole thing once again and then we will go to the final elaborate method of discounted cash flow method. All right, friends, I believe there's a doubt. Mr. Krishnan sir, no, it's not always 20x. It depends upon how much is the money that the venture capitalist is looking at. Now, normally this is said to be in the industry standard, at least based on the interactions that I have had with many VCs. 3 years, they look at least 10x. So today, whatever is there into 10 should be 3 years. So if you're talking about maybe 5 years or 6 years, they might also look at 20x. So the logic is very simple. I put 100 rupee today. After 5 years, I should be having at least 2000 rupees because they are taking high risk in this project, unlike any other people. So when you are doing based on venture capital, if you feel the risk is not very high, you can take a 10x, you can take a 15x. It's always based on your judgment. You can always provide these assumptions whenever you're doing it based on this. Okay, Deepak sir, your doubt is what is the major considerations while deciding which method to use? Deepak sir, as per the ICAI guidance note and the rules over here, we normally go only by a discounted cash flow methodology. But today's session when I'm taking, I'm not taking purely for a valuation report as such. I'm taking this based on the different methods that are used in the industry for convincing the investors. So when you go to an investor, they might look at these methods. Many of them will be even aware of all these methods. Now, Burkas method, many of them, the startup, the moment they come, they will know, okay, I cannot give them a higher valuation higher than $2 million. In fact, recently, one of the IT tech companies, high profile companies had come to Kerala to pitch, in which I was also a part, and they had a standard format. They gave $1 million as the valuation, blank valuation, and they said, I will invest money, 20% stake, whichever company they were willing, but they should be into IT with a particular criteria. So why we do these 9 methods is whenever you pitch in front of an investor, you go with one method, they will have arguments to counter you. But if you go there with 9 methods in front of you and all the methods given approximately similar valuation, they will not be able to argue much. Now that is the base of this. I hope I have cleared your doubt, Deepak sir. All right. Yes, I'll just repeat this whole methodology once again. Now, this is normally used by venture capitalists who take a lot of risk. They would say, after 5 years, I need 100 million valuation. And today, whatever money I put, I want a 20x on that. So that would mean today the company's valuation should be how much? 5 million. I am investing 1 million. So the value of the company before I put the money will be how much? $4 million. From this $4 million, is normally for listed company. Your company is unlisted. Because it is unlisted, it has got a lower value compared to a listed company. So that way what we will do, we'll multiply that with 70% dilution. You can take 70%, you can take 80%, you can take 60% depending upon how much you feel your company is strong or your company is weak. And you will get a net pre-money valuation of $2.8 million. Okay, I believe this point is also clear to all of you. Friends, we are done with the 9 methods except for one major method which we all use for the valuation of startups, especially as per the guidelines given by the institute. So this method is a bit elaborate. I'm not sure. Do we have a break in between, sir, or can I proceed? Just let me know how to do it.
You can proceed, Tarun.
I can proceed, right? All right.
Yes, yes.
Okay, so this method is a little elaborate. It is a little bit more of a technical method. It's more like a financial management class that you will be attending. But that is how the DCF method is done. And many of you must be familiar with this method. I'll just go in depth and give you the entire way of how we can value a company using DCF method. DCF method, the rule is very, very simple. Okay? That value of any business is nothing but the present value of future cash flows. Now, this is something what we already know, but we never numerically do it. For example, let's talk about celebrities. All right. Now, let us say my favorite celebrity is Mammootty. If Mammootty is acting in a movie, how much money can he charge for a movie? I'm not very sure about that. Do you have any idea? Per movie, how much money Mammootty charges?
3 crores.
3 crores, is it? All right, I'll just put 3 crores over here. Okay. Now, please help me with some flop actor in Malayalam industry. Any flop actor? Anyone? Or is everybody famous here? All right, let's assume some basic flop actor is there who is acting in a Malayalam movie. He will not be able to demand even 50 lakhs for a movie. What is the difference between this flop actor and Mammootty? If Mammootty does a movie, there is going to be a viewership for the movie. And there are a lot of people who will flock into the theater to watch the movie. So I can say value of Mammootty is nothing but the value depends upon the number of people who flock to the theaters and watch Mammootty's movies. And for this flop actor also, whoever it is, you can imagine any of your favorite flop actors, his value is also nothing but the present value of number of people who follow this particular person. Tomorrow, if Mammootty's subscribership falls down, in that case, his valuation will come down. The day his subscribers go up, his valuation go up. That is why everybody is hell-bent on increasing their YouTube views, because higher the views, higher will be the valuation. In fact, when Facebook took over WhatsApp, do you know how they did the valuation? They did not use any of the 9 methods that I mentioned over here. They had their own unique method. They counted the number of users that is there in WhatsApp. Let us assume there was 1 billion users in WhatsApp. They estimated that they will be growing at a rate of, let us say, 20% every year. And if they charge $1 per year from each of these people, the Facebook will make $1 billion revenue out of these people. And keeping this max, Facebook raised the valuation for WhatsApp, and WhatsApp sold its stake, and Facebook became the owner of WhatsApp. This is how majority of the valuations are actually taking place. It is based on the number of users that are available to you, and these users will indirectly generate future cash flow for the company, either directly or indirectly. WhatsApp might be free, but giving WhatsApp, the user base goes up, the database goes to Facebook, they use this database to make money. That's how the whole equation actually works. Same way, if you want to value a business using DCF method, there are two parts to this. Part number one is what I call it as the present value, and the second part is what we call it as of the future cash flows. So to take a present value, we should have a discount factor. You must have learned in your FM classes, you will be having discount factor of 12%, 13%, etc., etc. How this discount factor is derived, also I will be explaining over here. And future cash flow can be brought in using a particular formula, which I'll just give it to you over here. PAT plus depreciation minus cash flow minus additional working capital. All right, I am not going on depth of this formula. I will explain this to you in a very clear-cut manner. Step number one, whenever we do a valuation using DCF method, we should first go and take the audited financials of the company. This is what we take it as year zero cash flows. Friends, as I told you, value of a business, is it the value of today's cash flow? No. Value of a business is the present value of future cash flows that the business can actually generate. So audited financials will be your year zero cash flow. For example, I'm talking about profit and loss account. Okay. Year 0, 1, 2, 3, 4. All right. Year 1 to 4 is what we call it as future cash flow. All right. Here I will put the revenue. I will put my expense. So let's say my revenue in year 0 is 100 crore. My expense is, let us say, 60 crore. So I will be getting my profit before tax as how much? 40 crore. On this, let us say my tax is 30%. So that would be 12 crore. After reducing this, I will be getting my profit after tax of 28 crore. This is my year 0 base financials. Now, from your clients, you are supposed to take the future revenues. So that is something what you should take it on a management representation letter. You can never certify the future sales. It's only a management who can give in writing to you that these are going to be the future sales. So suppose the management tells to you, I'll just give a heading in crore. They say that, okay, year 1, my turnover is going to be 120 crore. Year 2, it is going to be 144 crore. Year 3, it will be, let us say, a 20% growth on this, or I'll take it as 180 crore. Year 4, they would say it will reach 200 crore. Management cannot predict forever. After 4th year, management would say, okay, from here onwards, my cash flow or my revenue will keep growing at a growth rate of 10% forever. This growth rate is what we call it as the standard stable growth rate. This is the data that the management will give you. From this data, sometimes management will provide you expense details also. If they don't provide to you the expense details, you can always predict the expenses based on two factors. Expense, you can categorize into two parts. Fixed expense, variable expense. All right. Fixed expense will be your rent, it will be your salary, etc. Variable can be, if you're into a trading company, you will have purchases, which is actually a variable thing. Higher the sale, higher will be the purchases, or I would call it as the cost of goods sold. That's what we normally take. And other than that, the variable would be, let us say, sometimes marketing expense. Many companies, including gold showrooms, what I see is they'll put a budget. Whatever is my sale, 5% will be going as marketing. All right. So that will be the variable expense. So you segregate all the cost into variable cost and fixed cost. Variable cost will be the percentage of turnover. Higher the turnover, higher will be the variable cost. Lower the turnover, lower will be the variable cost. It's basically a very simple projected financials that you prepare. And rent will be based on a 10% increment or a 20% increment depending upon the management estimate and the management policy. So once I do this, here step number 1 becomes very simple for me, because what I'm doing here is I'm preparing my profit after tax, which is nothing but something what I do in my projected financial statements. So let's say I get 28 crore. Here, let us say I'm getting 40 crore. Let us say I'm getting 50, 60, and here I'm getting 70 crore. I'm just giving some numbers so that you can clearly understand this part. This is only a projected P&L account. In the same manner, we are supposed to prepare the projected balance sheet and the projected cash flow also. So these are the three major things that we prepare while we go for a valuation report. I'll go step by step, friends. Otherwise, you might get a bit confused. This one is a very easy step. If you have any doubts here, please let me know. Otherwise, I'll go to the next step and explain to you how we do the next one. I believe everybody is clear with this. Now, these sales has to be given in a management representation letter, and it should be signed by them. Very, very crucial. Later on, we cannot take the risk of they simply projecting unnecessary turnover. All right. So this part is clear. Once we prepare our projections based on these numbers, we'll go to step number 2, where we can prepare the free cash flow of the company. Here I'll again put here, we'll have 0, 1, 2, 3, 4, and then it will go towards perpetuity. We will have a standard 10% growth. Here we use a formula, profit after tax. We will add back depreciation. Why do we add back depreciation? Because it's a non-cash item and it is something which does not affect your cash flow. Minus whatever is the capital expenditure. If you have any investments that you do, you have to reduce that. Okay. Minus additional working capital. Friends, whenever you grow your business, you need more and more working capital. So that is a fund which is blocked permanently. Anything which is blocked permanently, we will not consider over here. So if I go by the numbers over here, I got 28, then I took 40, 50, 60, and then I took 70. Assume my depreciation is every year 10. I'm just putting a basic number. And let's say my capex every year is 20. And let's say every year my working capital is going up by another, let us say 10. If I put it like this, so from my profit, cash profit, from PAT plus depreciation will give me what? This two together will give me the cash profit. From this, when I reduce the capex and when I reduce the working capital, I get my free cash flow, which turns out to be, in this case, 28 minus 30 will give you, 28 plus 38 minus 30 will give you 8. And here you will be getting 50 minus 30 will be 20. Okay. And here it will be 1 minute, 30, 60 minus 30 would be 30, 40, and it will be 50. I think there's a doubt in between. Okay. Should we consider changes in the non-current assets other than the fixed assets? Sir, all the non-current assets will come as capital expenditure. Basically, any fund which is going to get blocked has to be considered, because here we are focusing on cash flow. So when we focus on cash flow, only sundry debtors, creditors and debtors and stock, current assets we don't take into the picture, because we have an assumption that it will be released within a span of 3 months. So if I have a debtor today, I will get the money within the next 3 months. Okay, but all the non-current investments, whatever happens in the company, is a fund blockage, and it should be reduced from the cash flow. All right. So like this, when I do, I understand that this company is having a free cash flow of 20 crore in year 1, 30 crore in year 2, 40 crore in year 3, and let us say 50 crore in year 4. These are the free cash flows which can be distributed to the investors, and value today of this company will be the present value of all these future cash flows that we can take it today. I'll give you 1 more minute. Go through these calculations. If you have any doubts, please let me know now. Otherwise, I will go to the next slide. Yes, Deepak sir, you have a doubt? 1 moment. Can't we assume that all the expenditure will be met out of external fund sources? Deepak sir, every time you take an external fund source, we have to understand how you are taking this external fund source. Are you taking it by way of equity, or are you taking it by way of loan? Because here, when you do the free cash flow, only the equity investments is something what we do not consider. And ideally, we are, if you are looking at it from there are 2 points of views, to be precise. Maybe I'll explain that point of view to you. There is an equity point of view, and there is a long-term point of view. So when we talk about equity point of view, we would say that we are talking purely from the equity shareholders perspective. So here what happens is, whenever you take a loan, you will show this loan as an inflow, and whatever investments are coming, you show that investment as an outflow. But we never consider the share capital. I'll write down, don't consider share capital. That is because our valuation we are doing for the share capital. We cannot do the valuation for share capital after showing share capital as an inflow. I hope you are understanding my point. And when you talk about the long-term perspective, we talk about it from equity plus debt perspective. In this case, loans also, if you take, you will not show it as an inflow, because you are talking about the overall worth of the company, the overall value of the company. Only investments will be shown as an outflow. Sir, I believe I have clarified your doubt. Oh, Deepa, is it? Deepa madam, I hope I have clarified your doubt. So sorry. I read it as Deepak in one row. Yeah. All right. Thank you so much. I'll continue now. So this part is clear to everyone. We got the free cash flow. I'll repeat from the beginning. Value of a business is nothing but present value of future cash flows. To get the future cash flow, step number 1, you have to take the base as year 0 audited financials. Take all the revenue upcoming for the upcoming 4 years. From those revenues, we will take the projection and the free cash flow using the formula profit after tax plus depreciation or any other non-cash item minus capital expenditure minus any additional working capital. That will give you the free cash flow for the company. All right. Now, friends, the free cash flow does not stop here. After the 4th year, it will go on forever towards perpetuity. Okay. How to do that also I will explain to you. All right. There is a formula which we can use for that one particular part. So now what I will do is I will draw a table over here and I'll just show you. Ideally, how do we draw a table here? Cash flow, discount factor, discounted cash flow. Year 0, I will not take. I will take only year 1, 20, 30, 40, 50, and then it goes on forever. From here, it will go on at the rate of how much percentage? It will go on at the rate of 10%. All right. So step number 1 is over. We have found out the future cash flow. Once we get the future cash flow, what is going to be step number 2? We have to take the discount factor. How do we take the discount factor? When I learned my CA, okay, I used to get the discount factor directly in the question, 12%, 14%. In reality, what is the meaning of the word discount factor? Can someone please support me here? Please, can you tell me what exactly is the meaning of this word? Okay, I think I've got a very good question also over there. What is the basis for fixing the terminal growth rate? James sir, I will give you the formula for growth rate. I will give you that in depth, all right? Or maybe I'll give it to you here itself, all right? I think we'll start with the growth rate and then we will go to the discount factor. What is the base for the growth rate? For growth rate, there is a formula that we should use, and the formula is retention ratio into rate of return. How do I get the retention ratio? I can take it as 1 minus the payout ratio, all right? And the rate of return is nothing but it is ROE. So if I take 1 minus payout multiplied by ROE has a formula, profit after tax divided by equity plus reserves. Maybe I'll show you practically the growth rate for Zomato. Hopefully I should be able to find out if they have dividend declared. Now I'll take this Zomato company, all right? What I do is I'll take the financials. I'll go to the financials. In the financials, you have ratios. Click on the ratios. Okay, when you take the, hold on, this is not the ratios. Yes. Here, if you see, you have the book value, you have the dividend per share, you have the face value, you have the basic EPS. I want the return ratios. So here I get the return on net worth, ROE. If you look at the ROE for Zomato, it's all negative. Fine. I think I should take some better company to explain this to you. Let us take Reliance. Or I'll take Infosys. That's a high dividend paying company. Let me take Infosys. If I talk about Infosys over here, I can just come down. Infosys. I'll come down. Financials comes here. Ratios. In that I'll take the return ratios. All right. You see, they have an ROCE of around 36%. That means if they are investing some money, they are getting a 36% return over here. Multiplied by, they must be having the payout ratio somewhere over here. Turnover ratios, margin per share is not required. I think we'll take the margin ratios and see. No. Return liquidity ratios, current ratio, leverage ratio, turnover related ratio, growth ratios. They directly have the growth over here. Valuation ratios. They should be having a payout ratio also somewhere. If it's not there, we can go to the per share and find out. They'll have a dividend per share. 31 is the dividend per share. EPS is 52. All right. So I'll take 31 divided by 52. I'll get a payout ratio of 60%. So it will be 1 minus 60%. So the formula would be 40% into 36%. If I do this, I will get the growth rate as 14.40%. The logic of this is very simple. If I invest 100 rupee in the company, I get 36 rupee return. But what has this company done? Out of 100 rupees what they have distributed 60 rupees. Only 40 rupees is remaining with them. So this 40 rupee, if you invest at 36%, your company will keep on growing at how much percentage? 14%. This is how in reality you find out the growth rate. Sir, I believe I have clarified your doubt. It is ROC, return on capital employed, ROCE. All right. Yes. I'm moving to the next part, sir. If you have any other doubts, please put in the chat box. All right. Okay. So once you get the growth rate, then we go to the next part. We have to go and find out the discount factor. Now, please interact and tell me, friends, what exactly is a discount factor? Where can I go and find the discount factor? It is an investor's required rate of return. Exactly, sir. In reality, government bond rate. No, it's not the government bond rate. In reality, discount factor, why I never see this discount factor in the newspaper or in money control site or anything is because it is investors' expectation. And this investor's expectation can keep on changing from person to person. So ideally, this is the opportunity cost. Now, for example, suppose Tarun. Tarun is having 100 rupees with him. Tarun will have three options in front of him. All right. Option number one, Tarun can set up his own practice. He wants to start his practice, but he doesn't know how much return to expect. Option two, as someone rightly said, we can put the money in bond. Bond will give me, let us say, 6% return. Option number three, Tarun can put his money in dad's business. He can forget about practice and he can continue whatever his father is doing. And his father is giving him a return of, let us say, 12%. Now tell me, when Tarun is starting his practice, how much is the minimum return that Tarun will be expecting? He will expect at least 12%. Why? Because when you compare bond with dad's business, where is he getting a higher return, friends? He is getting a higher return in his dad's business here. All right. Suppose his dad was giving him only 5% return. Now tell me how much will be his expectation. His expectation now will be bond. Why? Because bond is giving 6%, father is giving only how much? 5%. So discount factor in a very simple term is nothing but it is the investor's expectation. Now, I would go to a next terminology, which is very important to understand this whole thing, which is called as RADR. All right. Now, Tarun is having two options. Tarun can do CA practice, or let us assume for a very hypothetical scenario, Tarun decides to enter into smuggling. Now tell me, how much is the return? Suppose in CA practice, Tarun is expecting a return of 15%. How much return will Tarun expect if he is doing smuggling business? I don't have any intention, friends, just a hypothetical situation. How much will be the expectation that I'll be having? Will I have more than 15% or will I have less than 15%? I will definitely have someone, Adarsh sir is saying that I'll be having 90% return expectation. Why did my expectation go up? It went up because I am facing higher risk. Higher the risk, higher will be the expectation. Sri Kumar sir, 100% with jail term. Wonderful, sir. Okay. So higher the risk, higher will be the expectation. Lower the risk, lower will be the expectation. So when we do a discount factor for any business, it is based on the risk. High risk projects will have higher discount rate. Low risk projects will have lower discount rate. And friends, risk can be measured using two factors. One is standard deviation and the other one is beta. Now, beta is something which is available in the stock market. So we can always use the beta to find out the expected risk of a particular personality. One doubt is there, 1 minute. James sir, your doubt is that how can we assume the investor's expectation when we do DCF? We are not assuming, sir. That's what I'm showing you. I'm showing you how we can find out the discount factor. I'm coming to that point. I have not reached there. So when we do the valuation, discount factor can be found out using a formula which is very popular, and you must have heard of this formula. It is called as a CAPM return. This formula had got a Nobel Prize also. As per this formula, the discounted returns that an investor can expect is found out using a formula RF plus beta into RM minus RF. Okay, so when you have a higher risk project, you will have a higher beta, lower risk project, lower beta. I can show you that. Let's take two companies over here. The moment you take in money control, you will be able to see the betas. It's available over here. Do you see 0.89? So Infosys is having a beta of 0.89. The logic of this 0.89 is that if market is fluctuating by 1, Infosys is fluctuating only by 0.89. So Infosys, is it more risky than the market or less risky than the market? It is less risky than the market. All right. Similarly, I'll take some other company. Let me take Let me try Zomato. It's a newly come company. It should be more risky. Let's check. Zomato, look, Zomato is having a beta of 1.7. So if market is moving by 1, Zomato is moving by 1.7. Whereas Infosys being a stable company, market moves by 1, Infosys moves only by 0.89. So higher the fluctuation, higher the risk. So if suppose I want to find out the discount factor for Zomato, what I will do is I will take the RF. So RF is basically the bond returns, which is 6% plus I will take the beta. How much is the beta I got over here? 1.73 multiplied by RM. RM means the market return. Here market return will be the Nifty return. So to check the Nifty, you have to go to the money control homepage. It's actually 12% right now if you take it as CAGR, but I'll just show you. If you come here, you see Nifty 50. Click on Nifty 50. You can take any one of the markets. You can take BSE, Sensex. You can take Nifty Bank. You can take any one of those. When I take Nifty 50, a graph should come somewhere. Hold on. I think this is the graph. How do I make it big? One moment. No, not here. Let me check somewhere else. Portfolio markets. Home. I'll click on Nifty 50 here. Yes. All right. Right now, Nifty is trading at 15,000 points. And if you come down, you'll see a chart. This chart will correctly provide you with the details of Nifty. I think money control site is little slow. Just please cooperate for a moment. I hope we still have time. Yes, it's 5:35. See, so here the market was up and now the market is amazingly down, but this is a 1-day fluctuation. When you take a RM, you should take a 5-year at least. So if you look at the 5-year growth you see over here, it started over here somewhere at 10,582. Today it is 15,782, right? So approximately if I do 15,782 minus 10,000, what was the starting point? 10,616. Okay, divided by the base of 10,616. In the 5-year period, they've got a 48% return. If I divide it by 5, around 10% is the market return. All right, precisely 12, but here I have got 10% as the answer. 10 minus 6. So if I write down like this, I'll get the answer as 1.73 into 4 plus 6. You get 12.92% as your discount factor. Friends, 12.92 is for a company which is listed. Is my company listed? No. I have to add a factor for DLOM. DLOM, the full form is discount for lack of marketability. A listed share can sell itself easily. Unlisted share cannot sell itself easily. So how much of a difficulty you have, normally we assume a 5% addition to the basic. So if I do that, 12.92 plus 5%, I will get my discount factor to be how much percentage? It will be 17.92%. I think this was a bit heavy. I'll give you some time to process this, and if you have any doubts, please ask me. This is how we find out the discount factor for unlisted companies. I think I missed a doubt. One moment. Yes, sir, I will explain DLOM once again. I'll explain that in the next page. Let this get over. 5% is an assumption. We can put 5, we can put 10. Depends upon how much you lack compared to the market. That's an absolute, it's at the discretion of the valuer. There is no standard presentation for that 5%. It can be 5. If you feel 5 is not sufficient, you need to add a little more, you can do that also. Normally, everywhere they add 5%. That's in industry practice. All right. I'll just explain DLOM once again. DLOM, the full form is discount for lack of marketability. Okay. Now, for example, I told you I found a food-based app which is there in Kochi called as Rizoi. All right, this is something similar to Zomato. Now Zomato is listed. For them, getting money is easy. Now this company is unlisted. So getting money for this company is not very, very easy. So when Zomato is listed and Rezoi is unlisted, what we will have to do is, this company if is having a 13% discount factor, here we have a higher risk. For the higher risk, we should add some form of risk premium. Now, how much risk premium to add is a matter of judgment. So normally, whenever we do a valuation, we do a 13% plus 5% for unlisted companies. You don't need a 5%. You can take, if you want 3% or 7%, depending upon your own judgment about how much discount factor is apt for Rezoi. All right, that's only to adjust the difference between a listed and an unlisted company. Please go through this. If you don't have any doubts, I'll go to the next part. All right, I believe everybody is clear. So friends, I'll summarize now. We have got discount factor. We have got the cash flow also. So now we have to find out the value. So as I told you, I'll write down over here again. Value of a business is present value of future cash flow. So here I'll draw the present value tables that you all must be familiar with. Here, cash flow, discount factor, discounted cash flow, 1, 2, 3, 4. What was the numbers? Let me check. 20, 30, 40, 50. 20, 30, 40, 50. And I believe we got a discount factor of approximately 18%. So you will take the discount factor. That will be 0.84, 847, 847, 0.718, 0.608, 0.515. When I multiply with this, I'll get a valuation over here. I need to also find out present value of perpetual cash flow. From year 5 onwards, there is going to be a perpetual cash flow. I think there's a doubt in between. Can we take a longer period, say 7 years? Sir, you can take 7 years if you are sure about the projection. Normally, 4 years only what we take will go wrong. If you take 7 years, 6th year, 7th year will definitely go wrong unless you have an absolute plan that year 6, I will be opening one branch over here. Year 7, I'll be opening another branch over here. Then you can go for 7 years also. There is no restriction as such. But normally, 4 years itself is a huge challenge to get that right. So I normally recommend people to go for a 4-year projection. So here what I'll do is I'll use a Gordon's model formula. I'm not explaining the logic of this now. The formula goes like this. P0 is equal to D1 divided by KE minus G. So here I'm taking the 5th year. That will be D5 divided by KE minus G is what I'm taking. So this will give me price 4. These are all technical things I'll show you in Excel. That will be easier for you to do. I just want to show you exactly how the things work. So year 5, it will be 50 plus 10% growth is what I told you, divided by 18% discount factor minus 8%. So here it will be 55 divided by 10%. You would get the number as 550 crore. This is at the end of the 4th year. So value at the end of year 0 will be 550 crore into 0.515. These are all pure FM calculations, but very important for valuation. You get 283 crore. Plus, if you add up the numbers over here, you'll get around 17 crore over here. 30 into 0.718 is 22 crore approximately. 0.608 is 24.32. And the last one would turn out to be 25.75. So if you add up all these, 17 plus 22 plus 24 plus 26, approximately you will get 89 crore over here. So if I summarize, I have got 89 crore over here. I have got 283 crore over here. And if I add up these two together, I'll get the total value. That would be 283 plus 89. That is 372 crore. There are too much of mathematics on the board, friends. Please go through it. I'll show you in Excel after this. Same answer you will get in Excel also. Excel is easier. You just have to put the things and you can do it. Logically, this is what we are supposed to do. If you have any doubts, please ask me here. The Gordon's model has got its own formula and its own logic, but I don't think we have time for that now. It's already 5:45. We need to have an interactive session also. Yes, sir. KE and G I will explain to you. KE is the discount factor. That is what we found out using CAPM. So if you're talking about Zomato, it had a beta of 1.73. So with that beta, the expectation today turns out to be around 13% for a listed company. Unlisted company, we are adding a 5%. So it becomes how much? Approximately 18%. That is the logic of KE. KE, the full form is cost of equity or equity holders expectation. If we are investing in a company, we are the equity holder and it's our expectation that I'm talking about. G is growth. I gave you a formula for growth, retention ratio into rate of return. How do you get retention ratio? You take the money control side, you get the payout ratio. 1 minus payout ratio will give you the retention ratio. So once you multiply, you will get the rate of return and that would give you the growth rate. So here I have taken the growth rate as, hold on, I think growth rate was 10%, right? Sorry friends, I made a mistake here. Thanks for correcting me. So it should be divided by 8%. 55 divided by 8% would be 687. There's a small mistake here, friends. Give me a moment. I'll just correct this part. Wait, this number will change and this number will change. I'll put it with reading pen. It was supposed to be 10%. So here I should have got 8%. 55 divided by 8% will be 688 crore. So here it would be 688 crore multiplied by 0.515 would be 354 crore. So 354 crore plus 89 if I do, I'll get 443 crore. Yes. So KE is investors' expectation and growth is the growth of this company. So I believe your doubt is clarified. All right, friends, I'll just show you the same thing with an Excel sheet. Yes, James sir, it's multiplied by 4th year factor or 5th year factor. It is multiplied by 4th year because when I do this, I'm taking the present value of this that comes to the end of the 4th year. Then here I should take the 4th year factor only. I'll show you the same answer in an easier manner. Let me open an Excel sheet. Okay. You will get the same answer what I got here. That will be a good proof that whatever we have done is correct. Screen is a bit overloaded. One moment, friends. How do I? All right, I'll just give an even spacing. Perfect. So I'll just give over here, year, cash flow, discount factor, discounted cash flow. We took 18% as the cash flow, right? And just confirm. Yes. So what I'll do is I'll put 18% over here upfront. And I'll put year 1, 2, 3, 4. Here, should I make it a little bit more bigger? So all of you can see it more clearly. Yes. All right. So year 1, how much was the cash flow? It was 20 here. And then I added a standard 10 everywhere, right? Until here. And then from here, I told there is a standard growth rate. So the discount factor formula would be 1 divided by 1 plus 18%. So I get 0.4847. Yes, that's exactly what I got there. And here the formula, I'll put it as this divided by 1 plus 18. And I can pull this down. So I'll get the, okay, wait, I think I made a small mistake. I should keep the 18% constant. Done. So like this, if I multiply over here, you check these are the same numbers I must have got there. 16.95, I've got 17 over here. Okay, I got 17 here. They are getting 16.95, 21.55, it is 22 over here, 24.35, it is 24, and 25.75, it is 25.79. Little rounding of difference. What I will do is, here 5 I will write over here. Now this is easy for you. Listen carefully. I told 10% growth rate, right? Into 1.1. Add plus 1 and pull this down. Take it to 200 years. Around 200 years, if you take, then you get almost the same answer, even though not exactly the same. You can take it up to the bottom of the Excel sheet also if required. It will just hang my screen, so I'm not doing that. And each of these years, the growth is going to be into 10%, right? I'll copy paste this. So it's going up by 10%. I'll take it up to 200 years. You want, you can take it up to 300. The more you take, the more accurate answer you will get. Discount factor also, what I will do, I will take it down. After a particular point, discount factor will be almost 0. After taking that, I'll multiply and I'll put the cash flow here. Okay, so after I put this, I'll just take the sum total of this, and ideally I should get the same answer what I got over there using all the formulas that I have used. That will prove that my answer over there is correct. I have got an approximate answer as 443. Let's pray to God this tallies with my answer there. I don't remember what was my answer there. Here I'm getting 443. Let's go and check. One moment. 443. Yes, see, we have got the same answer over here. I've got exactly 443 crore. So this is the proper mathematical logic in which I have done. Here you just pull it down, you will get the same answer. All right, and this is how you do the valuation based on DCF method. And normally in all my valuation reports, what I'll do is, finally I'll give a conclusion like this. I'll take DCF method, I will take net assets method. DCF method, I will put an 80%. Net assets method, I'll put at 20%. And here, suppose I got 473 crore. Here I must have got a value of 0. So here it will be 0. Here 473 into 80%. I will directly bring the value down to 3878 crore. So this value is absolutely reasonable, justifiable, and no questions asked. That's how we conclude our valuation. So I hope you are all clear with this, friends. So when we do the first Chicago method, we do this 3 times. Pessimistic, optimistic, most likely. 3 times you have to do this entire process, and then you take the weighted average. If you have any doubts on this, please let me know. Otherwise, we can go for an open interactive session with which we can pack up today's session. All right, friends, I'm stopping to share my screen. If you have any doubts, please let me know now. We will have an open interaction, after which we can wind up our session.
Messages in chat box, Tony.
All right, Pradeep sir, most of your doubts are clarified. Yes, different methods. If I ask in the end, it wouldn't have been satisfactory, so I did it along with the session itself. But any general doubts, if you have about anything, you can get in touch with me. You want my number and the email ID? I'll share that with you. This is my number. My email ID is mail@tarunjagdish.com. Yes, friends. Any other doubts you have?
Tarun, I hope you will share this PPT with us.
Yes, sir. I'll share it right away now. Can I share it through this app? No, right?
No, you can send to our email ID.
Sure, sir. I'll send it. I'll send it right away now. Okay.
So it was a great learning session. I request our Tony to propose vote of thanks.
Tony, I believe you're mute.
Thank you, Tarun sir. Honorable Chairman of the branch, CA Jose KV, respected colleagues in the managing committee, esteemed speaker for today's session, CA Tarun Jagdish sir, respected senior members and professional colleagues. It's my privilege to have been asked to propose a vote of thanks. I, on behalf of the entire managing committee of Ernakulam branch, would like to express our sincere gratitude to our speaker for today, CA Tarun Jagdish, for an insightful and interactive session. A big thank you, Tarun sir, for arming us with the tools of valuation. In the modern day, as chartered accountants, we are expected to be masters of the art of valuation. So today's session was a step in the right direction. I'm grateful for the session. Thank you, Tarun sir. To our chairman and my colleagues in the managing committee for all the support and guidance in organizing this session. And I would like to acknowledge the sincere efforts by our staff at the Ernakulam branch for organizing this flawlessly. And last but not the least, I express my heartfelt gratitude to all our members and attendees for attending in such healthy numbers. It serves as an impetus to us to organize such events in the future as well. I hope all of you had a great learning experience. Thank you and have a wonderful day.
Thank you, Tony. Thank you. Thank you, Tarun sir. Thank you very much.
Thank you. Thank you, sir. Thank you.